everything. Jordan, hello. Great to have you with us.
Good morning, everyone.
Let's start with sterling, Jordan. That has become really, really unpredictable, hard to trade. And I know you're scratching your head, and I read your note earlier this week. You've been really transparent, open, honest. You don't have a clue either. What are people saying to you?
John, I think we've gone back to the old ways of looking at the pound. Even though it's not Brexit, we're not talking about Theresa May giving a press conference, Boris Johnson doing this, none of that Houses of Parliament stuff. But we're looking at sterling with an inflation premium view. What's that about? Well, we've got this fuel crisis, petrol. People are struggling to get petrol in their cars. The UK is highly exposed to this gas crisis that's taking place in European energy markets. We're seeing the price of energy in the UK, just like the rest of Europe, spiraling quite a lot higher. But the one thing that has really made it really difficult for us all, John, is we've priced in Bank of England rate hikes. There's 3 rate hikes priced for next year. The pound's lower. So it tells me we've got to adopt the old sort of framework, which is keep an eye out for UK inflation expectations. If they keep rising, if energy prices keep rising, that's going to weigh on the pound.
Jordan, I'm going to ask a question, and I need to be a little bit open about this because I'll get a lot of hate mail. This is not my view before everyone starts sending me hate mail. Is this trading like an EM currency now, Jordan?
Yeah, it's the question you always get asked. It's trading like a developed currency that's having an inflation problem. And emerging markets typically have higher rates of inflation. So yes, in that respect, it's trading like an EM currency because we're focusing on that inflation metrics. But it's still one of the reserve currencies of the world outside the dollar. So we're not going to go too far and say it's untradeable. You can definitely trade it. It's just very unpredictable.
Jordan, Tom King, good morning to you as well. Is this a regime shift? Jim Bullard talks about a regime shift. Do we finally have a somnolent dollar giving us a big figure move kind of milieu for Q4? Is it a time to make big figures?
I think it is, Tom. We've had months now of euro dollar, for example, being in a very tight range throughout the summer. And I think as folks have gone back to the office, as we've gone back to work in September, it's kind of woken everybody up to the risks that were building up over that summer period. And euro dollar has been in a range, and we've had leverage. So the hedge fund community have been short the euro, but not the real money community, Tom. So what I've been saying to clients is I think euro is having its yen moment. If you think back to Q1 this year when US rates moved higher after the Georgia Senate race results, the real money community threw in the towel and all their dollar shorts against the yen. They went long dollar yen. They didn't do the same in euro. The European reopening story was still very attractive, and we had ETF flows into Europe. But that for the FX, that hasn't worked. And now we've broken below 116, which is the line in the sand for me. I think this is regime change, Tom. And we're looking for 114 in the euro against the dollar.
All right, that's the short term. But Jordan, you do see the euro going back to 122 versus the dollar, I believe. I believe that that was your call. Can you talk about the path to get there and how the ECB responds to some of the inflationary inputs, even though they call them transitory?
Absolutely. Yeah, the dollar view is still predicated on a global recovery. But right now we're going through a slowdown. The data, the surveys are all slowing down. So that's why we're talking about dollar strength right here and now. If we get into the sort of Q1 next year, we'll hopefully have priced in quite a lot of that slowdown. And then we'll start to focus on the positives again. The European mobility data is fantastic. The return to work in Europe has been much stronger than it actually has been in the US, according to the Google, the Apple data, and every other statistics we look at for. So that means maybe there's a European outperformance story next year. And also by December, we might have got the German coalition to announce the policies they will actually do, whichever coalition is actually formed. Maybe the market focuses on those growth numbers, and that could boost euro again. But for the ECB, they've got the same situation for the UK. Energy prices are going up. They're actually nearly double more important for European inflation. 9.5% of inflation basket in euro is energy. So energy costs rising is a big deal for their actual inflation forecast, but they'll be able to rest on the fact they've had a decade of low inflation. So the idea of them raising rates next year or the year after is very low. But for markets, what we'll be looking at is that 2024, there's already one rate hike priced in for the ECB by 2024. That's the end of it. So do we see the ECB raise rates in 2024?
Wait, hold on a second,
3
Jordan.
years away.
I have to really raise a question about this, because central bankers have broadly said that energy prices are not something that they look at for core inflation. That isn't going to necessarily bleed into their view in terms of whether to raise rates, since it has factors that go beyond monetary policy. Why is this time different?
This time's different because we've just had a record fiscal stimulus in Europe and the US. And also, we're having massive supply chain problems. So it isn't going to be just energy. It's going to be a lot of other parts of the CPI basket are going up. And the main thing for me is look at those consumer inflation expectations. They're not falling, they're rising. They're rising slowly, but over time, as energy prices feed through to people's budgets, when they see the price of their electricity bills, when they start to go to the shop and see food and clothing going up, they'll start to think maybe inflation is higher than 2%. I'm going to raise my inflation expectation. And that's going to feed through perhaps to wages. I'm not talking about a wage spiral. I'm not talking about an inflationary spiral. But we are talking about the direction is probably higher in inflation expectations, not lower. And that's something central banks respond to.